So we get the 50 basis point cuts. We're on the trajectory. We don't know where we end up, but we're going there. What's the immediate impact in your space?
Well, it's interesting because as a private illiquid asset class, there isn't the same level of immediate impact that you might see in a public asset. But it's generally, obviously, a very good thing and very supportive of real estate. And if you couple the lower interest rates with the fact that we definitely believe that we are at the end of this very gradual repricing that we've had in the private real estate markets, it really feels like a very, very attractive entry point. And it's a window that's not going to stay open forever.
Where is the attractive entry point, and what do you still not want to touch?
Well, I think the very obvious headline grabber, of course, is office is probably not at the top of our shopping list at this point, although I do believe that a lot of the hype has been quite overblown around office. At the end of the day, office is not going to be a needle mover going forward, in that right now it represents only about 4% of the investable universe of the public real estate markets and just under 15% of the private real estate markets. So it's really just not going to have a lot of impact. But where we do see the opportunity for great income growth, durable cash flows, and capital appreciation are in things like the living sectors, industrial real estate or logistics, and of course data centers.
What about offices that are no longer offices? There's a story on Bloomberg right now about how the old Goldman headquarters in the financial district, where many financial companies no longer are, were then turned into $4,000 a month apartments. Are those kind of opportunities going to fly off the shelf, you think?
I wouldn't say fly off the shelf. I think that would be just like a wonderful dream if all of the office that doesn't work anymore could solve our housing issues in the United States and around the world. But unfortunately, that is really going to be very selective. And actually, Lower Manhattan is really one of the best places to do that, because you have these smaller floor plate buildings that were built a long time ago on very small lots. So if you think about a really large office building with large floor plates, you would have very strangely situated apartments if you wanted to have any windows, because you'd have this whole giant area in the middle. And so that really becomes the problem is, do you have the plumbing? Do you have enough windows? How can you add natural light and not have an apartment that looks like a bowling alley? And so there definitely will be some opportunities, and actually those will probably be some great apartments when it works, but it's not a scalable solution.
What do you see as a bigger opportunity here as an investor? There's clearly an affordability crisis in housing in the United States. Shelter costs have been high. People want more supply. But as an investor, do you see more opportunity in apartment buildings, in single family housing? Where is the best opportunity?
Really, the living sectors broadly are great. And one of our global themes from an investment perspective is around demographics. And you think about demographics really lending itself across the spectrum of your lifetime. You have student housing, you have multifamily apartments, you have seniors housing, you have manufactured housing. So you, across the affordability spectrum and across kind of your lifespan, right? There's so many opportunities because there's undersupply in pretty much every single one of those sectors.
What are valuations like there? Because usually when I talk to someone deep in real estate, it's always going to be logistics, data centers, and senior housing, or student housing, or both. So what are valuations? Are all the money in that area? How do you differentiate?
Really, first of all, values have come down tremendously in commercial real estate, which is
across the board.
Across the board. Okay, so across the board, call it 20 to 25% down, but with office down 40 to 50%. So you have some sectors like manufactured housing in the private markets hasn't gone down at all. Seniors housing had a really tough run with COVID, and then had a really tough time with inflation, because if you think about labor inflation, very, very labor intensive operations, food inflation, we serve 3 meals a day to all of our residents. So it really has had a tough run, but we're seeing really markedly improved operations in all of our projects. So from a valuation perspective, we really think the living sectors are broadly valued very fairly right now, very attractively.
So logistics, is that like warehousing for Amazon kind of logistics, or is that data center logistics stuff? Really,
we think of those two things separately. Okay. So if you start with warehouses, industrial, it is a lot about Amazon and e-commerce and the rebuilding of supply chains, and it's something that we're still, very, very bullish about globally, particularly in very infill locations with high population centers. Data centers, different than warehouses, although from the outside they might look a little bit similar, much more expensive to build for sure. So data centers, the projections right now are for about a little over 20% compounded annual growth in demand for capacity in data centers over the next 5 years. So we were a very early mover from an institutional perspective in investing in data centers and started about 11 years ago. And at that point, our investment thesis was really about Netflix. And then it became about remote work and all of our video conferences that we're having all the time. And now it's about the AI revolution. So if you really think about a data center and AI, a data center is essentially like a digital classroom for AI. All of the AI is being trained in data centers.
So there has been so much money, to Alex's point, flowing into data centers recently. 11 years ago, you were there before many of these other newcomers were there, frankly. Yes. So how has that not made the valuation much more difficult in that area, especially because there are a lot of people who kind of worry about the energy needs around those data centers and the new infrastructure that it'll take to keep building them?
For sure. And if you think about, when I think about the data centers that we invested in 11 years ago, they were very, very different. They had much lower energy usage, much lower energy capacity, and they were for a totally different purpose. And they were not as large, they were not as expensive. And right now, the data centers that are being built are extremely expensive. And you can't do what needs to be done in this new 2.0 data center, which we call hyperscale. You can't do that in an old data center. It just doesn't work. So it's really about kind of building this new inventory that's going to be needed. And it's, there's tremendous demand